So let's look at our recent history in the S&P. Here's the past 10 years. From 2003 is where the bull market began to 2007 is where the bull market or the uptrend stopped. And they measure a bull market according to that move. So 5 years basically of an upward run. So far, we're in year number 2 of a new bull market. 2009 we bottomed, we rallied sharply, 2010 was choppy, and we're making new highs. Year number 2 of this bull market. Anticipate that everything sped up. Again, we would expect that there's more upside in the markets in the years to come. And there will always be, I just find it hard to believe that any real pessimist ever makes a lot of money. Don't forget that, the same pessimists that have always been there were pessimistic back in 2004 and 2005. And the market screamed higher for a couple more years. So while there are always concerns, remember that the markets build wealth over time. And markets consistently go higher over long extended periods of time. So that's not going to change any. Inflation speeds that process up. It raises asset prices, but we're still in a bull market and in relatively in early stages of that bull market. If we look at bear markets over the past 10 years, obviously the bubble burst in 2000. We had a 2-year drought, end of 2000 into early 2003, and end of 2007 into early 2009. 2 years each, big drops to the downside from where we stalled out until we bottomed. In fact, that was over 50% downside there from the peak to the valley. You can see it's violent, it's vicious, but there is some similarity between these charts, and we'll come back to that later on. As you look at the length of bull markets, as you look at the length of bear markets. So that suggests that over time we could easily come back up to retest these highs. It won't be next year in our opinion, but we will get there eventually. And then this was already a high from the highs back in the year 2000. So you've had your double top, and now we could accelerate to the upside. Okay. You also have kind of your double bottom area here as well. So market statistics from 2000 to 2003, we lost 45% of our value. You can see the downside. In fact, it was probably a little more than that depending on what your measure is. If you're looking at technology, I believe that bear market was even more violent. Well, I know it was. In technology, I believe they lost something like 80 tech stocks. NASDAQ lost 85% of its value, something like that. 2003 to 2007, you can see the bull run. Notice the average yearly gains. Year 1 was the strongest. Year 2, it carried over. Year 3 was kind of lackluster. That's going to be important later on. 2007 to 2009, again a bear market, huge downside, and further deterioration until we bottomed in March of 2009. So depends on kind of what dates you're going from, but it gives you an idea of how much value the markets lose and how much they gain in bull markets as well. So here we are, 24% gains in 2009, 13% upside thus far in 2010. What will 2011 bring? Well, remember that 2011, the third year in a bull market, tends to be a little less, and we would anticipate it's going to be a great year to be a trader. Plenty of choppiness, plenty of back and forth, plenty of opportunity. So what were the big business stories in 2010? Well, in January, Apple unveiled the iPad. Also in January, Toyota had to recall the pedals and all of the problems there. February, you had the Olympics in Canada. In March, Obama signed the healthcare bill into law. April, we had a mine explosion, very disappointing situation for Massey Energy, who was the company involved there. And also in April, the BP oil spill, which obviously was devastating. Read a piece today that anticipated that the BP spill would cost about $40 to 45 billion for the company, and that's a huge weight off their shoulders. Believe me, if it's only 40 to 45 billion, people would have been buying that stock hand over fist a number of months ago, and possibly even right now. So they can weather that storm. There were expectations. I remember Goldman Sachs putting out a piece that said that they expected the spill would cost BP over $200 billion. So not as bad as they had anticipated, or it looked like it was going to be from the start. World Cup in Africa in June and July. Financial reform bill gets signed into law in July. August was the big one, and here was what turned the markets entirely. The big turning point for U.S. stocks, August report. The Fed was meeting in Jackson Hole, Wyoming. This is where Ben Bernanke really announced that quantitative easing part 2 was on the table, and that was at the very end of August. We'll look at the market reaction to that. November, we had the midterm elections, and then in December, they've announced tax cut extensions going forward. So our 2010 price targets, these were all made below, and here was our expectation. Remember, this is from December of last year. We said, well, we're bullish over the intermediate term. We're expecting the next 2 to 5% move to be made upward. That's in January. So we'll look at that. We expect the next 10% move, however, in the markets will be made to the downside. We'll also look at that. And then we said our price target and outlook for 2010 was, and we're going to look like fools, down 9.4%. We had a price target of the S&P going down to 1,020. Now remember, this was our expectation for last year. So markets to pull back to 1020, down 9.4%. Well, let's take all that we said there and take a look at the market. Here's January. Remember the first comment. We expect 2 to 4% more upside. The markets rallied 3% higher in January. We said the next 10% move will be made to the downside. We pulled back 9.2%. Well, we shorted the market here, and this is what's important about trading. Setting a full year price target is almost like asking, a weatherman to say, well, what's the weather going to be like on August 3rd in 2012? I mean, it's pretty hard to predict because a lot of things change over a 1 year period of time. We looked at some of those predictions. Now, we're not making excuses because I've been doing this for years. Some of you know my background. I'm a former broker. We've been putting out these predictions for years. I've never hit it right on the percent. Never, ever. So the point is, it's an educated guess at best. But here's what's important. 9.2% pullback in January. Then we turned bullish. Markets turned higher. We rallied up and admittedly started to doubt this rally a bit too early. Now, we didn't short heavily against it, but we started to warn people, and I remember some of our members saying, why don't you just go with the flow? The market's going up. What's your worry? And when the markets topped out here, we'll talk about this important level here at this high, this 1230, 1228 type of area. When the markets rolled over right here and broke to new lows, we heavily shorted the market. In May, we had the flash crash. For the market, that was a big, important day. May 6th, I believe it was. You can see the huge bearish candle. You see the drop. We were short the market. Importantly, we dumped every long position and got heavily short. Remember what our price target for the year was? 1,020. Okay? This was a key level of support for the S&P, and we said by end of year we think we'll be at around 1020. Well, we hit that, but 2010 was like 2004 in that we were in a choppy year. Not only did we hit there, we still had time to recover and blast off to the upside. So everything sped up. All this volatility, all these moves at a faster pace. Great for traders. When we bottomed here, we were able to play the markets back and forth. We were caught off guard at the end of August as it broke out right here, admittedly. We had got short some stocks, but dumped them that day and got heavily bullish the market and heavily bullish precious metal related stocks for this run. And currently we have definite bullish flavor to our accounts, to our trading rooms, to our core investing room going forward. And as we said, we really like the agricultural space. So trading is about making money in all of these different ebbs and flows. But admittedly, again, we expected to fall to 1020. We did. We just didn't stay there. If you'd have asked us, and here was the key turning point. Look at that surge higher in August. This is when Jackson Hole, when Ben Bernanke, the Fed chairman in Jackson Hole, said, well, we're going to institute quantitative easing part 2, where that's kind of on the table to do so, and the markets zoomed higher. And you can see big, huge, expanded range bullish candles. We emphasize that when you're looking at a market, always pay attention to the size of the candlesticks. When you have huge bearish candles after long extended runs higher, or big sized bullish candles after big extended moves lower, those are a great sign of a turning point, of a follow through type of day, and you want to expect more upside. Well, we converted to the bullish side. We were believers very quickly. Here were our picks and pans. So you can see these were the sectors we liked going into the year. And as we always suggest, it's about stock picking. It's not so much about the market. So we would have said, well, we're going to go long energy and material stocks. We're going to play precious metal and natural resource stocks to the upside. And we expect to have underperformance in financial, consumer discretionary, healthcare, home builders, housing related stocks, etc. Okay? Well, out of those expectations, here's basically the outcome. Out of those, check marks are pretty good and X's are pretty bad. We got admittedly the retail, the consumer space wrong. We anticipated that they would underperform this year. They have not. But other than that, we would call it 14 out of 16. Financials definitely underperformed. Home builders, big underperformance, and so forth. Big outperformance in the precious metals. So let's look at a little more closely the sectors we liked and how they performed. There was no sector industry that we were more bullish on than precious metals. It also created the most profit for us, most likely. Gold prices up 28% for the year, silver up 80% for the year. In April, was it April or March, early this year anyway, we put out a piece that said we anticipated silver would far outperform gold going into through the remainder of the year. At that point in time, the silver to gold ratio was at about 65. So it was 65 times more expensive to buy an ounce of gold than to buy an ounce of silver. Since then, that has come in about by half. So that's the huge outperformance we talked about. We've played silver through silver itself, SLV, and through silver Wheaton, SLW, many different times. Our view has changed on this sector going forward, and this is important. We're now neutral to bearish. We'll talk more about that. In large part, that change has come due to an improving economic picture. If the economy is going to improve, now granted, part of that's due to the quantitative easing and so forth, but if we're going to see some recovery for a period of time, we think there are far better places to put your money than in precious metals. So yeah, if inflation takes off, and that will happen at some point in 2012 and 13 and so forth, will these be good? Yeah, I would expect gold to go to 2,000 an ounce and beyond over time, just not next year. We think this will underperform for a while. Now, here were our total trades. This year we were very bullish on precious metals. We took 21 total trades, 15 bullish, 4 neutral, and 2 bearish. Out of those 21 trades, 15 were profitable, 6 were losing trades. Our average return per trade was a positive 14%. So every time you took a precious metal play, counting the gainers and the losers, we on average made 14% in the trade.